But like, he doesn't need him. His blood pressure is normal.
I'm cold now all the time. It's like it's freaky how your body just can't really adjust.
All right, guys, we got quite a few folks rolling in, so I think we're 2 minutes past the hour. I'm sure others will continue to roll in, but why don't we go ahead and get started? So Tyler, if you want to queue up the recording and let me know when we're ready to go.
We're ready to go.
Beautiful. All right, everyone, welcome to the Q2 2022 VECKTA webinar. We're incredibly excited to host what will no doubt be a very informative session on an extremely important topic in on-site energy development. Developing on-site energy systems is new for most business leaders. Historically, energy, the lifeblood of most businesses, has been as simple as consuming from the local utility. However, with rapidly rising energy costs, decreasing grid reliability due to extreme weather events and supply-demand imbalances on the grid, and increasing consumer, investor, and regulatory pressure to decarbonize, businesses are being forced to explore alternatives. Unlike consuming from the grid, which is by and large pay per consumption, on-site energy systems, which can be composed of a variety of technologies like solar, storage, generators, fuel cells, wind, and now increasingly EV charging infrastructure, often have high upfront costs and low operating expenses, which some business leaders see as a barrier to implementing an on-site system. This is where on-site energy financing steps in to enable the adoption of these systems. Today, we're joined by on-site energy financing experts, Ammar Nawaz and James Coombes. In today's session, we'll discuss the different commercial structures, the types of projects those commercial structures are most appropriate for, how incentives impact the overall project, sample projects, how companies can prepare for financing, and what the near future looks like for on-site energy financing. Now I'm excited to introduce our panelists. Ammar Nawaz is VP of Distributed Energy Solutions at Electra Energy Solutions, and he's based in Toronto, Ontario. Ammar is a driven energy professional, commercial growth leader, and technical expert with over a decade of hands-on electricity industry experience, including enterprise strategy development, new venture commercial growth, M&A, and regulatory reform initiatives to facilitate utility business transformation. He's an electrical engineer and holds a master's in laws in energy and infrastructure. Ammar also serves as director on the Energy Storage Canada board and the former chair of Professional Engineers Ontario, West Toronto. James Coombes is a commercial project developer at Y Green Energy Fund, and he's based in Northern California. James has been financing infrastructure for 28 years, initially telecom and wireless in the 90s, and then renewable energy and commercial real estate for the past 14 years. He works with a range of developers, commercial and industrial property owners, and niche sectors including agriculture, wineries, and nonprofit organizations. James has a degree in economics and rhetoric from the University of California, Berkeley. We're also joined by our very own Aaron Hunziker, head of capital markets here at VECKTA. Aaron has spent 20 years in oil and gas and power, ranging from trading to business development to project finance. He oversees VECKTA's capital provider network, who routinely provides capital projects of all sizes. Aaron holds a degree in finance from University of South Florida and an MBA from Emory University. And I'm Dan Roberts, head of sales and marketing here at VECKTA, and I'll be your moderator for today's session. A few administrative items. This session is being recorded, and a recording will be sent out to all registrants. There is a Q&A function, so throughout the session, please add your questions as they come to you, and we'll do our best to address them at the end. There will be a couple polls during the session, and we encourage everyone to participate. And with that, why don't we kick it off with our first poll, really just to get a better understanding of our audience. So I'm going to go ahead and put that out there. Please go ahead and respond. So the question is, are you currently developing or planning to develop an on-site energy system? Either you are currently developing a project, you're considering a project, you're a developer or financier, and you may be working with others that are developing projects, or no, you're maybe just here to learn a little bit more about, and your sentiment may change in the future. So looks like we've got quite a few votes rolling through. I'll go ahead and publish our results. It looks like we're a little bit across the board, but looks like for the most part, we've got 42% that are currently developing a project. So a little bit heavier on those that are developing projects. So All right. With that, appreciate everyone's participation with that. I think I want to kick it off just with Ammar, James, giving you an opportunity to share a little bit more about your firms, your roles within the firms, and then from there we can dive into a little bit more of the different commercial structures. But Ammar, if you want to kick us off, tell us a little bit more about Electra and your role within Electra.
Yeah, thanks, John. I want to thank you and VECKTA for inviting me to the conversation. Also want to thank the other participants as well. Really glad to be sharing the platform with James and Aaron. I think it's a really good dialogue, and we'll get into that in a bit. Just brief introduction. Ammar Nawaz. I'm the Vice President of Energy Solutions at Electra Energy Solutions. Electra is a local electricity distribution company in Ontario. I would say we are probably the second largest municipally owned electricity utility in North America. We serve over 1.1 million customers with a $5 billion balance sheet, and recognizing the utility business in a bit of a flux these days. And a lot of the utilities are thinking about transforming themselves and becoming that utility of the future. Electra really has done some amazing stuff in that regard, and we're definitely perceived as one of the most innovative utilities, I would say, in Ontario, or for that matter in Canada. And we're definitely embracing the disruptions that are coming our way. We recognize our customers are a lot more sophisticated than they were at some point in time in the past, and they expect a lot more from their energy systems. And they want a very different type of relationship with their utility or energy services provider. And from that perspective, Electra really has a vision to become the integrated energy services provider, not a utility, integrated energy services provider, where we act as your trusted advisor and give you optionality in terms of choosing your energy systems and platforms. And my role within that strategy and evolutionary process is to lead that transformation from an energy solution standpoint and deliver tailored energy management solutions to the customers behind the meter, for the very reason that you articulated in your opening statement. So very happy to be part of this discussion today. Thank you.
Great. Thanks, Ammar. James?
Yeah, thanks for having me, guys. So I'm a long-term leveraged lender through Y Green Energy Fund. It's a financing structure that many people in California and some other states know as PACE, also known as Property Assessed Capital Expenditure Financing. So what we do is we provide long-term financing from 10 to 30 years. While PACE is often associated with solar and with renewable energy specifically, now it's a financing format that applies to everything from batteries and energy storage, a lot of ancillary improvements such as electric vehicle charging, and then types of improvements far outside of the energy sector. We're financing everything from new apartment construction to irrigation and other water conservation measures. And so the one thing I'd highlight is that PACE financing is ultimately a private long-term loan product. It's privately provided, not government provided. And it is available in a large part of the US, but to the extent we have developers who are outside of California and the Northeast and some of the other PACE markets, we can certainly break into that over the course of the conversation. So what I like about it is when I was doing leverage lending build out of internet infrastructure 25 years ago, the question from clients was, how do we get big enough to be able to do a project when we had a minimum issuance size of $100 million or $200 million? And now the nice part about it is we're funding projects from $100,000, $500,000, $1 million and up on a regular basis. So it's a nice transition of leverage lending sort of to the regular property owner, not just the Wall Street elite.
Great. Thanks, James. Well, really, really excited for both of you to join us today. And so let's get into a little bit more of the different financing structures. James, you mentioned PACE, and I know you have some experience in more traditional lease financing as well. So maybe you can spend a few minutes talking about those different structures, and then we can kick it over to Ammar and have him talk specifically about power purchase agreements.
Sure. It's always interesting to me when people use the word traditional in financing, because that tends to mean that they're doing something that they're familiar with, or they think the market's familiar with, and It's not necessarily in perspective of the broader history of finance, but I'm glad because you said traditional lease financing, and truly commercial leasing is the vehicle, other than a mortgage perhaps, that has the most kind of traditional background. It's 50 plus years. Somebody could correct me. Maybe it's even further back that corporations have been doing equipment leasing to take advantage of tax benefits. You know, you fly an airline, chances are the airline doesn't own the plane. Somebody else who has federal tax liability can own the plane. And so leasing even then sort of evolved to be specific to certain types of energy improvements, particularly when, at least for those of you in the US, we have a tax credit that's applicable. And so that means solar energy and now storage. And so a lot of companies that are doing, for example, power purchase agreements for solar and storage now evolved into that industry from being leasing companies, or at least leasing professionals in the past. And then, so you had kind of leasing, which was typically a 7 to 10 year product. And then some investors got the appetite to go longer term, 20 or 25 years, and offer power purchase agreements. I could give you some more background and history of those. They've sort of evolved over time to serve smaller projects. But then the countervailing effort there is, you know, the capital markets have this, you know, way of cycling back and kind of, you know, punishing overly aggressive or unprepared investors. And so you'll have periods where people try to do smaller projects, and then, you know, the capital sources aren't quite there, so they pull back. And so it's one reason I'll generally highlight it's important to work with, you know, companies with experience and track record. And a lot of people like to advertise track record in terms of pipeline or projects they funded at different companies, and that's all important. But what I always encourage is look at a specific company's track record in funding. So you want to see like an entity or bank or financial institution or investor that's done, you know, at least dozens, if not hundreds of projects. And that's one of the kind of due diligence factors I often recommend my customers use. And then over the past 10 years, we've started seeing PACE financing, property assessed capital expenditure financing, evolve first in California. But now, you know, in the better part of, if I said a dozen states, a lot of people would tell me that's too low. If I said 24 states, people would tell me that's too high. But it's expanding throughout the country. It's legislatively enabled, but it really requires investors who are capable and experienced in navigating the legislative authorizations to actually fund projects. And so depending on the state you're in, it's worth a deeper discussion, Dan, with an advisor like VECKTA, who can kind of help you hone in on, you know, hey, what is permitted and available based on the legislative environment, the regulatory environment in your utility, in your state, and so on. But that's how over the course of the better part of 15 years, I've sort of worked with a range of financing solutions. And the takeaway from that I'll leave you with is every project might have a lot of possibilities, but typically for a customer's specific objectives and limitations, there's really going to be a narrow range of those that'll be applicable to a specific project, not like you're selecting from, you know, a dozen different options on every project. So take it back from there.
Yeah, maybe one brief add-on is, can you talk about the specifics of PACE itself? I know that that's an area that you've done a lot of work in.
Yeah, so the way to think about PACE is long-term fully amortizing debt. These days, people are evolving even more customer-focused iterations like interest-only periods and things like that as you get to larger projects. But just think of it as fully amortizing debt. So it was really applicable, for example, on solar projects where you have this sort of, depending on who you ask, 20 or 25-year financing timeline you need to be on to make a project really beat the energy cost that the customer is avoiding on the grid. And so PACE was nicely structured so that we can do those 20 or 25-year terms. Or often in states like Florida, where we do a lot of business that have lower power costs, we can even go to 30-year terms to help customers beat their avoided cost of power. I've been doing this a long time, and I always have customers tell me that they want to do a project and it's not about achieving a positive cash flow on it. But the reality is, in certainly 90%, if not closer to 100%, customers are looking to achieve a financing cost that's lower than the amount that they're saving on grid power. And so PACE fit really nicely into that framework. A lot of, including on some of my own publications, you'll see people kind of comparing and contrasting PACE versus a power purchase agreement to finance solar. It's not an apples to apples comparison. There are tax benefits. There is performance responsibility. There are sometimes construction financing factors that play into that. So they're not necessarily apples to apples, but as a starting point, remember, every customer is not going to be as sophisticated about this. They don't live in it every day like we do. I always tell people who kind of join the company, remember how confused or how overwhelming it is the first day, because if we're not careful, every customer we talk to feels like that. And we don't want them to feel that way. So that broad brush, well, what's it going to cost me is important. A lot of these procurements are led by the facilities management side of the business, who aren't talking to the CFO and the treasurer and the tax people and all that. And they're told, well, go out and procure. Now, from a company standpoint, you ultimately need to integrate that conversation. This isn't an HVAC procurement, and you're going to make decisions that are going to involve tax benefits and operating considerations and things like that. I mean, the reality is large companies say, well, we don't want to deal with operating the system, and we're often willing to surrender massive tax incentives so that we don't have to look at this as an ongoing operational hassle. And let's just do a power purchase agreement where all of those costs are passed off to somebody else, which is fine and it works well. But in the US, you can often fund 40 or 50% of your system costs by just filing a tax return. And so that's expensive money to leave on the table. And that's where, on the flip side, when we have customers who either have very high power costs or have very high federal tax bills or both, the PACE solution fits in nicely because they can get a low cost of capital on a long-term financing while they keep the tax benefits on the system. We can break out into separately, but they can be substantial. And these days, now that you have performance guarantee and O&M companies like Omnidian out there offering solutions to help make sure your system's running, and you have very qualified energy storage vendors to make sure you're cycling your storage product correctly, the idea that you need a PPA to offset operational risk is not the only way to go about that. So that's just to highlight, when you think about the scheme of things, cost is certainly one, but then layer tax benefits in there, operational aspects, and other factors. And so at least it forms that kind of a trade-off. And I'll finally comment that with PACE, because it's not just a payment that's based on the performance of a system, we can fold in other types of technology, such as, Dan, you and I are working on a project with a substantial energy storage component. That's viable. And in California, the customer retains the entire utility incentive associated with that. We often fund roofing that's required to build the solar. We often fund HVAC that's being redone for San Diego Blood Bank, for example. We funded kind of a building envelope of HVAC and roofing and solar and controls. And then energy, standalone generation equipment and things like that. So we can kind of fold all of those in, even items that aren't tax credit basis eligible, where a solar PPA wouldn't be able to, include those. And then there are some cases where a company may need a PPA for the solar piece, but there's that whole host of other items, and there's no reason you can't even do a scenario where we fund sort of everything else, and then the PPA investor funds the solar project that sits on top of that new roof and that new HVAC and everything else.
Very nice, very nice. Thank you for that overview. And Ammar, let's learn a little bit more about these PPAs or power purchase agreements.
Yeah, sure. Thanks, Dan. I think James provided a really, really good summary and a really good contrast between PACE financing and the PPA. And I'm going to build on where James left off. And clearly, as he pointed out, there is a big distinction between why you would consider PACE financing versus why you would consider a PPA. And PPA, really, in the simplest term, really is power purchase agreement, where you're getting into a long-term contract with a third party who is coming in to develop a project for you, and you become the off-taker of the benefits. Now, obviously, the cost of capital and how you finance those projects is one consideration, and it may be a very significant consideration, but there are many other considerations when you think about the entire lifetime of a project. So typically, what I would like to highlight is some of the key drivers for a PPA, some of the key considerations for a PPA, and it fits the risk appetite of certain customers. They may not fit the risk appetite of other customers. So there are customers out there purely from a finance standpoint who have excellent credit. They're great counterparties, and arguably they could potentially raise money for a lot cheaper than any third-party service provider. So there's an argument that if your balance sheet allows, and if you have that credit capacity, you could certainly go ahead and raise that capital on your own quite competitively and finance those projects. That's just the finance angle. But then when you flip over to the PPA, naturally there's a risk of project development, project delivery, EPC, design, you have ownership risks, you have operation risks, you have performance risk, you have repairs down the road. So to an entity that says, look, my core business is not energy, right? Maybe I'm a hospital, so my core business is to focus on patient care, and therefore I don't want to take on this extra headache, irrespective of the fact that I can issue debentures and raise money, and it'd be a lot more competitive. I want somebody to come in, enter into a long-term power purchase agreement with me, and all I want is to be that off-taker of a guaranteed outcome and a guaranteed product. So that now becomes a black box in terms of technology, and of course everybody has a say on the technology, but how it is being operated, if there are any issues. So that becomes a consideration for the PPA provider. And so when you look at it from that lens of risk and transfer of that risk, PPA does become an attractive option. But obviously, financially, it may not compete relative to if you were to develop that project yourself. It really comes down to how you price your risk and who is better suited to take over that risk on your behalf. And so I would leave the audience with that consideration. Now, there could be a lot of other drivers to consider behind the meter assets more broadly, whether you do it through PACE or you do it through PPA. Naturally, you have your utility and that delivers power to you. But we all recognize that customers now have very unique energy needs. Some have sustainability goals. Some have higher reliability requirements that utilities can't meet. Some want to participate in the market action and generate, some savings or potentially even some revenues for them by leveraging these behind-the-meter assets. So there is, I think, a lot of potential for customers to take advantage of on-site assets. From a topic of financing, you definitely have a lot of options available to you, as James pointed out. The benefit of a third-party PPA is, and that party, I would say, has to be reputable, somebody who can stand behind the PPA for the next 20 years, and has the wherewithal to be able to deliver and guarantee you that outcome that you had initially signed up for day one. So if you can find the right party to do that, then it really is a transfer of risk for the entire term of that contract over to another party, and you become the off-taker of the benefits. And there's a price that comes attached to it relative to self-financing.
Ammar, that's a really good point. And you mentioned mitigating risk and those with good credit. How do you guys go about mitigating your risk when they might have less than stellar credit? Do you take a look at shorter PPA terms? Do you take a look at collateral or parent guarantees? Like, how would you go about someone that maybe is not, S&P, just superstar, for the folks that maybe have less credit?
That's an excellent question, Aaron, and it's a pretty significant consideration. We live in a risk-adjusted return world. So I think it comes down to how you view the counterparty credit risk. And there are ways to mitigate that. Shorter PPA is one way of looking at it, to the extent that the price or the cash flows would allow the customer to consider that. Parental guarantee is another good example. If you have parent co that has better credit or some sort of security, and there are instruments out there and potential investors who would invest in some of those, I would say, less than stellar credit profiles. So as a PPA provider, you know, Electra would also look at not only just deploying equity as an example, we would also look at deploying debt with our partners. And there's, I would say, a wide range of appetite, type of projects that you would want to finance. But ultimately, it really comes down to the counterparty credit risk, how you price that, and it definitely has an impact on the price per PPA.
Yeah. So as we've been talking through this, one of the things that comes to mind is there's a wide and for the folks that are joining us today, we've got a wide variety of call it facility sizes or potential system sizes. And so are any of these, and James, maybe you want to jump in first here, are any of these vehicles more appropriate for systems, say on the relatively smaller end of the commercial industrial scale, several hundred kilowatt, 500 kilowatts or so, then looking at maybe a larger system in the 4 megawatt range all the way up to a rather sizable system in the 10, 15, 20 megawatt range. So are these, should we be thinking about these different structures in size of project?
Yeah, to segue from the underwriting conversation we were just having, because it's a good connection here, with PACE financing, it's a little more complex than, in banking, we refer to it as sort of the investment grade clients. And then, Aaron, you referred to it as less than stellar credits, which is a diplomatic phrase I've used over time. Of course, on Wall Street, we called it non-investment grade or high yield. And in the popular media, it was junk bonds. But I'll tell you, I've really enjoyed working with sectors like franchise hotel owners, where they're not only comfortable operating at high leverage levels, but they're acquisitive and they want to expand their businesses. So they don't want excess equity tied up in their business. And so, some of these folks, if they're not operating at 80 to 90%, lean to value, and they're back out trying to get more debt and recap anyway. And so we're comfortable operating in that relatively highly leveraged customer range where typically the PPA investors, who are often, composed of some, tax equity and other sources behind that, want a more traditional credit profile. And so certainly there are non-investment grade PPAs, and certainly we do PACE financing for stellar credits, as you refer it to. But just to highlight that, yeah, our underwriting is fundamentally different because we're looking at the property. We're not looking at personal guarantees or corporate developer guarantees ever. And so it's just a very sort of different profile. So I segue that to sort of the size question, because I tell people there are multiple factors, and it's not as simple as just saying 3 or 4, but we kind of talked about pricing already. And I said that's an important one, but it's necessary, but not sufficient to make a decision. Underwriting is one. The better pricing is only important if you can get approved for a project. And then the transaction size. And so this is a nuanced one where I'll say, if you go to the extremes, so when you talk about anything with double-digit megawatts, at least in the solar context, you're not necessarily talking about a utility project, but you're starting to talk about stuff that looks like a utility project. And so those are generally going to be big enough, and especially if there's storage attached there, where you're going to be looking at a PPA solution, and probably what I would call a highly developed PPA solution, meaning not necessarily an on-site generation project, but something where you're looking at somebody else's land that you have to go and entitle and get all the necessary, interconnection and transmission filings. That's what the developers on the call, that's what they do. And so when you get into the size range of, let's limit it to say whatever on-site generation means. And I've certainly seen some multi-megawatt, upwards of 5 megawatt on-site generation projects. That's where you start to get into the realm of, hey, you might have, ability to go different directions, whether it's a tax lease or a PPA or a PACE deal, or, hey, let's not forget traditional, truly traditional, commercial mortgage financing. And so to the extent the customer has decided they're not going to simply self-finance or finance with their mortgage, it's in that range of sort of 1 to 5 megawatts where I'd say you want to be evaluating both. And I'll put another twist on that, which is PACE and PPA refer to kind of general product types, but not every PACE financing and structure is the same. And certainly not every PPA structure and financing is the same. I had somebody 6 or 7 years ago when SIA came out with their template PPA trying to tell me that this was the standard PPA format. And I said, just with all due respect, there's never been a deal done on that template, you know. And at the time with American Renewable Capital and Technology Credit, we had done 400 PPAs. And I said, if we're just looking at the number of PPAs done, I think 400 compares favorably if we're going to talk about a standard document. No, those were 100 kilowatt and 200 kilowatt PPAs. And in the megawatt and 2 megawatt range and up from there, I mean, Ammar is going to have, you know, the list of kind of currently active participants. But I just say, sort of to my earlier point, look at track record for what people have actually done, not what they aspire to do, not even really what they've done at other companies, unless there's a direct tie-in there. You know, I had a company that merged with another company, and so that was relevant. If you have the same investors that have, for some reason, just kind of taken to sponsoring a new entity that's going to be selling you power, then that may be fair. You know, Wells Fargo financed PPAs for NextEra and SunPower and whoever else. But the specific PPA developer you're working with and their track record is really important in that. So there's a lot of players right now in the PPA game who have done larger deals, community solar deals, utility deals, who are proposing to come in and do 300 kilowatt commercial solar PPAs. I would propose that those are two fundamentally different businesses to be in. And similarly, you know, I've done a lot, our firm has done a lot of sort of under $10 million PACE financing. But if you're looking at doing, and there have been 50 and close to $100 million PACE financings, then yeah, that's a fundamentally different product when you get to the large scale size range. So I guess to summarize to your point on project size, I would say, and I also made my note here, geography is a really important factor in this, because there are some states, and with respect to Canada and ROW, they all have their own regulations as well. But in the US, there are a number of states that don't allow power purchase agreements. There are a number of utilities that don't. There are many that do. There are certainly a lot of states that don't have PACE financing. So some combination of price, size, credit, and geography or regulatory should all kind of factor into that range. And that's where, Dan, I think you guys are really focused on bringing sort of the right viable options to the table, you know, rather than going to Wikipedia and reading, hey, what are all the ways I can finance my solar or energy generation project, half of which or more may not be relevant to a given customer.
James, I got a question for you. Some of our customers really don't have any interest in the energy component, like owning the system outright, but some do. Do these systems, you know, whether it's PACE, tax equity, you know, flip partnerships, do they all have ability to own a system? Is there stuff in the contract, written language?
Yes. So that's a good question, because people phrase this differently. And I've had some customers tell me, or developers tell me, well, my customer doesn't want the tax credit. So when I hear that, the tax credit equals money. And so to tell me your customer doesn't want money, there's another layer we need to peel back there. So I just asked the question. Now, what they're likely saying is my customer can't monetize the tax credit. That's one. What they may also be saying when they say my customer doesn't want to own the system is my customer doesn't want the operational responsibility, risk or upside of owning the system. They want to have somebody else do that. And those are both very common, very reasonable positions to come from. But for the customer whose perspective is, I want to do a project and maximize my savings, if not year one, at least over a period, you know, in a reasonable lifetime of the system, then the answer is yes. Most third-party ownership structures, we're talking about PPAs. We could have a separate conversation about prepaid tax equity structures, but with PPAs, most structures will give the customers buyout options. In the US, if you've worked with the sort of Keith Martin, John Marciano kind of group from, it's not Chapman and Park anymore, but they've generally advised that you can provide customers 2 buyout points at which they can transition ownership. But the real question to look at on all of those is how is the buyout option or early ownership option priced? And that's where there's been a big movement, especially on larger projects, to requiring an appraisal to determine fair market value at the buyout. There were different approaches to that, let's just say 5 years ago. And so I'd say just kind of look at the approach to transitioning ownership and whether that's a predetermined fair market value or an appraised fair market value. It's always going to be fair market value, but look at the method by which fair market value is established and at what points in time that option to buy out exists. Because like I said, typically tax attorneys will tell you you can offer 2, but I've certainly seen PPAs that offer more buyout options than that, as opposed to a standard loan financing PACE or mortgage where you can typically pay the financing off at any time, with moderate to no prepayment premium. Did that address your question?
Yes, it did. Thank you.
Yeah. All right. So, and I'm keeping an eye on the time. I do want to make sure that we reserve a few minutes at the end for some of the questions that have been coming through. I think, Ammar, maybe we can shift a little bit, and James has hit on a couple of incentives, and I think maybe you can tell us a little bit more about the tools that a PPA provider like Electra has to make a project a little bit more approachable for energy users. What are some of the things that you're able to use on the back end? And maybe there's some specifics to Canada, and I know you do some projects here in the US as well, but what are some of the tools that you use as a PPA provider?
And then just so I understand the question correctly, your focus is more from a financing and a cost competitive standpoint, or the way the
incentives or how you package incentives to make it more approachable for your customers. Yeah.
Right on. Yeah, no, that's again, I think building on the previous conversations, cost of energy is very real for a lot of the customer. It really affects their competitiveness, and naturally, our goal in the Ontario market context is to package a PPA, that's at least market competitive relative to the grid, and also allows them capabilities to then potentially save some money on their energy costs, or even make some revenues by participating in the programs that might be available. Now, the good thing is that Ontario electricity market is pretty green. That may not be the case in many states and many provinces. In the Canadian context, we do have a number of funding streams available from Natural Resource Canada. CIB also provides some very low cost capital loans, and they're very much focused on the energy transition, right? So green energy, renewable, electrification of transportation and fleet. So when we look at a potential project, we're looking at a few projects right now, which is in the transit space. You say, how can we come in and electrify your transit? And naturally comes with that the component of on-site energy solutions and a potential PPA providing the entire infrastructure as a service. So we would look at those funding streams that might be available from the federal government, or low-cost loans that government is making available for a lot of the entities to make that energy transition a bit more competitive, right? And also advancing that transition. So that's a big factor that comes in how we would look at certain investments and price for PPA. And then again, going back to the conversation around the counterparty credit risk, investment grade versus non-investment grade, and what we can do in that regard, that also has a huge bearing. So it's a combination of different things, Stan. We would look at government mechanisms that might be at play, funding streams both from the municipal, provincial, and then also federal, and pull everything in. And then depending upon the counterparty credit risk, as an investor, you could take on a bit more risk and settle for a little less return. And that all makes sense. But PPAs, as James pointed out, gives you a lot of optionality. And one other quick thought, just on the transfer of ownership. PPA, again, I like what James said, there is no one template off it. It really, as an investor, where you're willing to live with, and where your customer can sign on. So we would provide transfer of ownership throughout the contract term, right? It is subject to a value. It could also be early termination transfer of ownership. It could also be transfer of ownership at the end of the contract. or potential renegotiation of the PPA for another term for a lot favorable pricing. So it gives you a lot more flexibility.
Yeah, no, I'm glad you touched on that, Ammar, and appreciate that overview. So the last 3 months of we've seen some maybe volatile market dynamics, and curious how that has impacted your businesses, how that's impacted your interactions with customers. Has it at all? I don't know if either of you want to jump on that first, but yeah. Feel free, James.
Okay, so and having been in the energy and real estate business long enough to remember what happened in 2008, I'll incorporate some kind of history in this. So with PACE financing, we typically price as a spread to treasuries. And so obviously, and the funny thing is, obviously for years and years, that essentially meant fixed pricing. And over the past 4 to 5 months, that has definitely not meant fixed pricing. Once the deal's priced and funded, it's a fixed rate financing, it's not floating. But how we price has obviously changed by probably 150 basis points, or depending on what's happening in the world today. And so you have the system that's continually kind of letting off steam. So it's not like there are tons of projects contracted in the pipeline that are getting more and more underwater as rates go up. They're typically priced as a spread. So as the market increases, the pricing increases. What I've noticed and talked to my, at least US PPA development colleagues is they're not really adjusting pricing, or at least not adjusting IRRs at this point. And so that's great. And I'll say 2 comments. One, coming from the development side, you can't, every time the market moves one way, you can't pull up all your stakes and go home, because the next day the market moves the other way and you've kind of thrown in the towel. And so I think when you have a good developer mindset, there's some patience and flexibility with pricing. But I think then you're not letting off steam bit by bit as the market changes. And so the bigger question for PPAs will not necessarily be, hey, has there been a 150 basis point, change in your prospective returns? But more importantly, at least again in the US, is have you lost or retained your tax credit investor appetite? And so that's where I think the third-party funders who have a broader range of tax equity investors will have a little more pricing stability. And by range, I mean, there are banks and institutions, there are corporate funders. There, more so than 10 or 15 years ago, there's a lot of private money. Some call it high net worth. I'm not sure it's necessarily high net worth, but certainly tax based money in the market. And so some of that money can go poof, very quickly, depending on what industry it's coming from and what they have to put to work. And others will probably be more resilient than the banks, whereas we all learned the banks can lose all their money overnight. And that means losing all their tax appetite, as we call it, meaning ability to take the tax credit. Whereas corporate or individual investors may have more, more staying power. There was always this myth that retail investors were more fickle than corporate investors, when I was in banking. But if you look at it, actually, a lot of personal investors have a lot more stability on what they're willing to buy and hold, and corporates or institutions can tend to move in and out more quickly. So time will tell what happens here, but just to say that it's a good due diligence question to ask is, hey, what's going to happen? Forget about the tax credit going down by 4% next year. That's a relatively modest impact in pricing. And you still have bonus depreciation and a lot of other tax benefits. The bigger question is your ability to monetize that going to still be there or not? So you don't get into an existential question of whether your tax equity source disappeared.
Thank you. Ammar, any insights on how things have shifted, or have they?
Yeah, then just building on that, I think, from a PPA provider standpoint, it really depends on size and scope of that PPA, which really, I think, comes down to the big question of how do you come up with your return expectation given the market has moved so much, right? What it does to your weighted average cost of capital. So that's a consideration we're having to contend with on some of the larger PPAs. So given what we have seen in the past 3 to 6 months is something we were not anticipating, and no idea how the market might continue to move over the next 3 to 6 months in the bond and the equity space. So that has an impact. Secondly, some of these PPAs, depending on size and scope, will have a large development cycle. So between the time when you put in your proposal to the time when you're signing the definite docs, the market has moved. And who bears the risk of that? And to what extent you want to transfer that risk over to the customer? And then what does it do to your competitiveness? So I think it has an impact. Naturally, a lot of people have many considerations, and either it might take the PPA provider out of market, or the PPA may not seem as reasonable and as attractive to an off-taker if you transfer all the risk over to them. Not to mention, given what we have seen in supply chain, and I want to highlight that because as a PPA provider, it's not so much as taking a contract over and getting the customer to sign on the dotted line. You still have to build the project. If you've been keeping pace with what's happening in the supply chain with the availability of battery storage or solar panels or inverters, the pricing is changing, I would say, by the hour. Any of the providers that we have that we currently deal with, they can't hold their prices firm for more than a week or 2 weeks without getting a firm contract. So then as a PPA developer, you have to make cushion for a lot of those adjustments in addition to the market moving risk on top. So number of moving pieces, a lot of considerations.
Definitely. I also realize so I have another poll for the audience, and if I had posted it before this last discussion or prior or post, may get different answers, but I'm gonna go ahead and ask it now that folks have a little bit more information. So, have the market dynamics over the last 3 months impacted your business's on-site energy plans? Building an on-site energy system is important, and we're focused on doing so. Yes, we're considering a different approach. Yes, we're reducing the scope of our project, or yes, we're abandoning it altogether. Folks are still on. Go ahead, I'll give it another 5 seconds or so. All right, yeah, it looks like folks are considering a slightly different approach given the market dynamics over the last few months. So appreciate everyone's participation there. All right, so in about the 10 minutes or so that we have left, I did maybe, can we take a minute or two each and just talk about a recent or relatively recent project either of you have worked on or both of you have worked on, and just talk through some of the nuances there. Again, I want to reserve some time at the end. We've got a couple questions that have come through the audience, but yeah, maybe a recent or in the past year or so project that you've worked on and some of the specifics there.
Yeah, happy to take that on then. So we're currently looking at several projects that involve solar and storage, and also electrification of transit and fleet. So typically, the way we see it is it's very much how can you come in and capitalize on this ongoing energy transition. The approach is really to provide a full solution from grid to plug in the event of electrification of transit and fleet. So these are really cool projects because you see a lot of different technologies coming together, the microgrids in action. And in many of those instances, the local utility grid is not able to handle that kind of load. And I keep telling a lot of the folks here, it's not really an energy issue. There's a lot of energy. It is a capacity issue, the size of the pipe on your distribution feeder, and how much can it handle instantaneously. So that's an area of a lot of interest, as of late. And we've seen the entire market shift, I would say, during COVID, where sustainability used to be a nice to have and afterthought, has now become, a must have and a very important consideration. So, but the cool thing is, that you're seeing a lot of these technologies coming together. There's solar panels, energy storage for resiliency, backup generators for additional, on-site reliability, and then how do you manage charging for transit and fleet, and then also take all of that and help them be super efficient in terms of the load that they put on the grid, right? And how do you monetize some of the benefits and the credits that might be available? So it really is a major transition towards microgrid that we're seeing.
Ammar, I have a quick question before James jumps in. What does that relationship look like between lender and borrower these days? Is it more hands-on? Is it starting earlier in the process? How would you characterize? Because a lot of the times we get questions saying, "What happens after financial close? Will they be in touch with me? Is it like when you buy a mortgage and you just don't know who your financial provider, might be in 2 years?" How does that relationship, since it is a relationship business, how has that maybe evolved in the past several months?
Yeah, that's an excellent question, Aaron. I think you have many different types of lenders, right? Some are purely financial investors, and others are strategic, like Electra. So we view ourselves as strategic. We believe in building that relationship, and obviously, the early on you build that relationship, and the more hands-on you are, the better the outcome for all parties involved. But having said that, you have very sophisticated financial investors that are really looking at everything coming together, and they will review it just kind of like any bank, and establish that relationship. So a key question for a lot of your customers is, are you working with a developer that has a good financing partner available to them, or are they going to make you sign a contract and then shop around? And what we have seen is a lot of developers who rush to sign the contracts and don't have established and involved relationships with a financing party or an off-taker tend to run into a lot of challenges, and customers also tend to run into a lot of challenges. Where you are doing a lot of the code development early on with a strategic or with a financial investor that's invested in the project, believes in the value proposition, believes in the off-taker vis-a-vis the customer, the outcomes are a lot better because you're able to weather that storm together, and nothing is static, as we have learned in the last 6 months.
And James, I'm going to ask for an example, but short and sweet, because I've got two key questions that have come in that I think are really important, and we'll reserve the last 5 minutes for.
Yeah. So first, project economics always matter. And even if environmental puts the facade that, hey, we're doing this for some other reason, those projects still only happen if it meets the return parameters, whether it's a no upfront cost, cash flow, whatever. And there's certainly a lot of people I work with where environmental is even factor into things. This is purely an economic transition. And it's important because for everybody out there sitting in areas where they don't care about the environmental per se, these projects aren't being done to check environmental and sustainability and lead boxes. They're being done to provide cash flow, tax savings, whether it's even long-term hedge or near-term cash flow or both. So Dan, you and I are working on a project that incorporates both solar and storage it's a great kind of opportunity because here you acquire a business. We won't name the customer, but you acquire a business. It's got a significant electrical component of their operating expense. And here's something where by doing a financed investment, we're also bringing in a tax credit investor alongside the PACE structure in that. So just to kind of highlight, just because we're going the PACE path doesn't mean we have to leave the tax credit, necessarily to the host owner. We're also bringing in a separate investor alongside us to monetize the credit. And that's a solar and energy storage project. And so the benefit here for the customer in this case is a new acquirer of the business over the past few years, haven't built up a lot of federal taxable income at that entity level. So we're helping to monetize that and reduce a significant portion of their operating costs at a time when, they've gone through COVID, they've gone through rebranding, they've gone through, these other, it's a retail oriented business, right? And so they've gone through all these issues, and here's a way to monetize the credit for them, deliver them positive cash flow / reduce their operating expense, not just through the solar project, but through the storage, which particularly in California is becoming more important as utilities have to have this kind of base load, non-peak hour power, and rate tariffs have kind of adjusted to incentivize that. It's a really nice kind of 1-2 punch for other areas where storage isn't as important. I guess the takeaway I just say there is combining multiple measures, and in some cases while still monetizing the tax credit, is something we can do very effectively, with pace, whether that's public companies and REITs, or small individually owned, hotel franchises, gas stations, and nonprofits and houses of worship. It's a nice kind of package solution that works in that sort of 5 million project size or 500,000 project size.
Great. Thanks, James. All right, in the few minutes that we do have left, one of the questions that came in from the audience, which I think is really poignant. What should my team and I be looking for in a finance partner? Are there red flags we should be looking out for, or things that we may not be readily apparent to us that we should keep in mind as we look to engage with a financing partner? And I'll let either of you take that.
In the interest of time, sorry, I'll jump in. I've always said that financing partners should be subject to as much due diligence as your developer or contractor you're selecting. I've said a couple of times on this call that I think track record of execution is critical, and that means ideally track record of a specific company. The individuals in it and their experience is important, but the track record of that company is critical. Back in the 2015 timeframe, we saw a lot of names, including big names that at the time at least you would recognize, like Sun Edison, rest in peace, coming in and saying they could finance small commercial solar projects. And not only were they unsuccessful in doing so, they built up significant signed pipelines of business for customers who counted on them to provide a financing solution, which they represented they could provide, and not through, there was no financial blow up in the 2015, 16, 17. In fact, if anything, we saw a substantial commercial boom. But they were unable to deliver because they were trying to port what was fundamentally a utility model or a large commercial model down to a sector of credits and system sizes that they had never served before. And so I would say in a market where I see people who have done one thing in one part of the country at a specific size and customer type, trying to do something that's very different, ask those questions. And I would just say there are a lot of people out there who are going to choose only on price. But if you've ever done a home remodel, as my wife and I are attempting to do now, the trade-offs there go without saying. So,
Just finished up one myself, and I couldn't agree more with the analogy. Ammar, anything you want to add with that?
No, I think James captured it beautifully.
Excellent. Well, we have a couple other questions. I want to be conscious of time and wrap up here within the hour. And I'd say, just to build on what you just shared, James, we concur here at VECKTA as far as making sure that energy consumers are connecting with reputable, strong track record, vetted organizations, whether that be financiers like both of yourselves and your organization, or constructors, equipment, other parties that would need to be involved in order to get these projects developed and companies achieving their overall goals. So that's something that we all share, and really appreciate your time, your participation, your partnership, and excited for all the things that we can do together in the future. And so thank you, Aaron. Thank you to our audience. And yeah, that wraps our Q2 2022 webinar. And thanks, guys. Appreciate it.
Thanks for having me.
thanks, Dan.
All right.
Thanks, Aaron.
Take care, all.